Imagine having a tool that instantly tells you whether buyers or sellers are winning. Not by guessing, but by observing the collective weight of the market's own actions. Imagine a tool used by the world's most elite hedge funds, the largest global banks, and the most successful professional traders. This isn't a secret held by a chosen few, but a fundamental pillar of institutional strategy. It is a tool that helps remove the fog of emotion, the fear, the greed, the hesitation, and forces you to focus entirely on the objective facts of price action. That tool is called the moving average. Today, you are going to learn how to master one of the most widely used and respected indicators in the financial world. By the end of this lesson, you will understand why professionals never trade without it. Look at any stock chart. To the untrained eye, it looks like pure chaos. Prices constantly moving up again, and down again. For beginners, this noise is overwhelming. It's hard to tell if a stock is actually growing or just experiencing a temporary bounce. A moving average helps you simplify that noise. It is quite literally the average price of a stock over a specific period of time. As new prices appear every minute or day, the average changes, which is why we call it a moving average. It evolves with the market's heartbeat. Think of it as a smoothing tool. Instead of obsessing over every small, insignificant price movement, it allows you to step back and see the bigger picture. In the world of professional trading, seeing the bigger picture is often more important than watching every individual candle. Professional traders understand something fundamental. The market is designed to create noise. News, rumors, fear, and greed create short-term fluctuations that can trap the unwary. Moving averages act as a filter, removing the static to reveal the underlying truth. They help answer one simple critical question: what is the trend? If the price is consistently trading above a moving average, it is a clear signal that the buyers are in control. If it remains below, the sellers are winning the battle. It is a simple, objective way to judge market sentiment. Moving averages help us identify trends more objectively, removing the bias of our own hopes or fears. Remember episode 6, where we learned that understanding the trend is critical. Moving averages are the primary tool for that identification. They provide a baseline for reality. There are hundreds of moving averages, but as a student of the market, you only need to master 3: the 20-period, the 50-period, and the 200-period averages. Each represents a different time frame and a different level of psychological importance to the market participants. The 20-period moving average, often used as an exponential moving average or EMA, reacts quickly. It follows the price closely, capturing the immediate pulse and short-term momentum of the move. It is the favorite of active traders who want to stay on top of fast trends. The 50-period moving average moves more slowly. It is the bedrock of medium-term trend identification. Many swing traders look to the 50-day average as their primary guide, as it filters out more noise than the 20, but remains responsive enough to catch significant shifts. Then there's the 200-period moving average, the granddaddy of them all. It is used to identify the major, long-term trends. Major institutions, banks, and sovereign wealth funds watch this level with extreme care. When a stock is above its 200-day average, it is considered in a bull phase. Trading above the 200-day average signals long-term institutional strength and confidence. But when a stock trades below this line, it may signal fundamental weakness. Knowing where the price sits relative to these 3 levels is half the battle in understanding market direction. In our previous lessons, we discussed support and resistance. Most beginners only look for horizontal levels. But moving averages offer something more sophisticated. They are dynamic. They move with the price, providing a floor or a ceiling that is constantly evolving. In a strong uptrend, you will often see price pull back, touch the moving average, and then continue higher as if it were bouncing off a physical floor. This happens because millions of traders are watching these exact same levels, creating a self-reinforcing phenomenon. This isn't magic, it is consensus. The more participants who respect a level, the more powerful that level becomes. When a stock touches its 50-day average and bounces, it's because institutional buy orders are often sitting at that level, ready to defend the trend. This consensus makes moving averages a self-fulfilling prophecy. They are not magical indicators, but because the industry uses them, they become part of the market's own structural reality. Professionals use them to identify where the big money is likely to step in. Many beginners make the fatal mistake of thinking indicators predict the future. They don't. Moving averages are not crystal balls. They are tools for observation, nothing more and nothing less. They don't tell you what will happen tomorrow. They tell you what has been happening recently. That context is vital because it allows you to make better, more informed decisions based on evidence rather than hope. Professionals use moving averages as part of a larger process, not as a shortcut for thinking. They are a piece of the puzzle, not the whole picture. Now let's discuss two of the most famous signals in all of technical analysis: the golden cross and the death cross. A golden cross occurs when a shorter moving average, like the 50-day, crosses above a longer one, like the 200-day. This is a powerful signal of a momentum shift. This event is widely viewed as a long-term bullish signal, indicating that the tide is turning and a new bull market may be beginning. It shows that short-term strength is finally overcoming long-term resistance. Many long-term investors use this to confirm their entry into a position. The opposite is the death cross. This occurs when the shorter average falls below the longer one. It is often a warning of a significant long-term downtrend. It signals that the recent weakness is starting to weigh down the major trend and that sellers are taking control for the long haul. But remember, no signal is perfect. A golden cross can fail, and a death cross can be a bear trap. These events should be viewed as pieces of evidence in a larger case. Professional traders think in probabilities, not certainties. They look for confirmation from multiple sources. Institutions do not ask, "Can this indicator predict the future?" They ask, "What does this indicator tell us about the current reality of the market?" That is a completely different mindset. They gather evidence, trend, volume, support, and moving averages to build a case for a trade. The goal isn't perfection. The goal is to increase the probability of success. By aligning yourself with the moving averages that institutions respect, you are aligning yourself with the smart money. You are trading with the wind at your back rather than fighting the current. The big lesson is this: moving averages help you stay aligned with reality. They reduce emotional decision-making, help identify trends, and simplify complex charts. They remind us that the market is not about predicting. It is about observing and reacting to what is actually happening. The better you observe, the better your decisions become. Success in the stock market doesn't come to those who guess the best, but to those who observe the most clearly and follow the evidence with discipline. Moving averages are your clearest window into that evidence. Now for your homework challenge. Open 3 different stock charts today. Add the 20-period EMA, the 50-period SMA, and the 200-period SMA to your screen. Observe which stocks are trading above all 3 and which are trapped below. See how they react when they touch the lines. Observe which stocks are changing direction. Do not trade. Just study. Observe the behavior. Learn to see the patterns before you risk a single dollar. This is how you build the eye of a professional. Study, observe, and learn the rhythm of the averages. Tomorrow, we will study volume. Because price tells you what happened, but volume helps explain why it happened. It is the footprint of the big money. Subscribe to Wealth Entertainment 21 and turn on notifications so you don't miss the next step in your mastery. Remember, the market rewards those who follow evidence, not emotions. I'll see you in episode 9. Stay disciplined, stay focused, and keep learning. This is Wealth Entertainment 21.